Hello, everyone. My name is Penny Noss. I'm the Senior Vice President for Innovation and Competitiveness at the German Marshall Fund of the U.S., a think tank based in Washington, D.C., and in 8 capitals in Europe. And I want to welcome you to today's event on transatlantic trade, tax, and corporate strategy. What next in 2026? We've got a fantastic panel of experts to help guide us today on our conversations around what to expect in the tax, particularly in the tax realm in 2026. We held a similar event last year as we were looking into our crystal ball, trying to anticipate the one big beautiful bill, as well as some of the international moves that were going to take place. And we will do something similar today. Now, let me introduce our panel that we have today. First off, I'm going to introduce Sean Bray. Sean is a German Marshall Fund non-resident fellow. So welcome, Sean. He is also the Vice President of Global Tax Policy at the Tax Foundation and Policy Director of the Tax Foundation Europe, where he researches international tax issues with a focus on European tax policy. He has previously worked both in the U.S. Senate on tech, telecom, and trade policy and in the European Parliament. Welcome, Sean. Thank you for joining us. Next up, we have Lauren Pons, who is a tax partner at Skadden, advising clients on legislative, regulatory, and international tax matters, including the TCJA, Inflation Reduction Act, and the OECD Pillar 1 and 2 reforms. She previously served as Majority Tax Counsel on the House Ways and Means Committee and has extensive experience in transfer pricing and global tax policy. Thank you, Lauren, for joining us today. And last but not least, I want to recognize Jennifer Weinhardt. She is Director of Tax Policy for the Global Business Alliance. Global Business Alliance is a trade association comprised of large global companies whose headquarters are outside the United States. She brings over a decade of public and private sector policy experience, including tax advocacy for technology startups and several years on Capitol Hill. She's recognized for her expertise in navigating complex legislative and regulatory environments to drive effective tax policy solutions. So, Sean, I'd love to kind of start our conversation today with you. Last year, you and I hosted a preview of 2025 and potential transatlantic tax issues. Since then, the landscape has shifted. I think the Trump administration went in a few directions more aggressively, particularly on tariff policy, than we anticipated last year. Tensions around Greenland and Ukraine have put in question as well the future of the US-EU trade framework and transatlantic relations more generally. Against this backdrop, can you give us a sense of where we currently stand on US-EU trade and tax policy?
Yeah, thanks, Benny, and thanks for having me on this panel, and thanks to my co-panelists here, Lauren and Jennifer, for joining as well. So you're right. We had a conversation last year at GMF, kind of describing what we thought might be coming in the new Trump administration, and at the time, I laid out some potential roadblocks that I saw as being probably, they would cause some friction, but we didn't know to what extent they would cause friction. And those, certainly were the Pillar 2 discussions, which is around the global minimum tax. I laid out a little bit about digital services taxes, or DSTs, and kind of the Pillar 1 side of the OECD agreement. And of course, tariffs were on the table given President Trump's track record and campaigning, but we didn't know to what extent that would apply to Europe, and in what directions they would go. So I think it's fair to say that in some areas we've been more successful as a transatlantic community of trying to bring people together, and in some more recent ways less so. So I'll start kind of on the positive side. I think Pillar 2, the global minimum tax, is a place where the United States actually has recommitted to some of the international work that was done under the Biden administration and actually the Trump administration previously, by coming to a so-called side-by-side deal, essentially saying that the United States has a global minimum tax from 2017. Pillar 2, which is the international system, also exists now and is in more or less effect in Europe. And so we came to an agreement to say that these systems are going to coexist side by side. There are lots of technical details that tax experts fight about all the time, but I think the big picture is that it's a place where the United States actually recommitted to kind of the international scene. On the flip side, we've seen, of course, the trade wars, the tariff policy of the United States. At one point, we were discussing if value-added taxes were unfair somehow to the United States, and of course, digital services taxes. I think where we are now is up until about a week ago, I would have said the trade situation is more stable. Of course, Greenland has, I think, shifted that a little bit, which we can get into more. But kind of the roadblock upcoming from last year that is still this year, I think, is the digital services taxes debate. And so DST still exists in Europe. The United States did not get any kind of concession in the trade agreement framework in with the EU previously. And I still think that's a pretty sore spot on the US side. So I'll stop there for the introduction, but I think we've solved some things, we've made some things worse, and we've got DSTs kind of in the future as a big roadblock upcoming.
Penny, I think you're
There we
muted.
go. I'm, going back to being muted. Um, Thank you, Sean. Thanks for that start there. Jennifer, I want to turn to you because one thing that we didn't predict last year was a tax issue that came up in 2025 known as Section 899. And you guys at the Global Business Alliance really took the lead on this legislation for the European business community. What and beyond. Talk us through some of the lessons you learned from that, as well as what you think some of the ramifications are of that fight for transatlantic relations moving forward.
Sure, and thanks for having me, and thanks to my fellow panelists. I think there are a few lessons learned, some of them directly related to tax policy, others sort of more broadly, I think, speaking to how uh, global companies and others, frankly, interact with Congress and some of these provisions going forward. I think maybe most broadly, the overarching shift that we're seeing is tax policy has really become a tool in diplomacy. I think more so than we've seen in recent years. And it's become a lever, sort of something that Congress can pull, or even the administration can pull, to retaliate or influence the actions and behaviors of other countries. So, in this case, it was what was happening at the OECD with respect to Pillar Two, um, pulling that lever to try and instigate some sort of change. And I think if you sort of take a step back and look at the Pillar Two experiment more broadly, it really ultimately, I think, drew the ire of Congress. On the one hand, you have the Republicans who certainly spoke out, regularly on Pillar Two, but it also you saw the same thing, I think, on the left as well. They were not fully on board. And it was sort of an effort to try to propose another alternate minimum tax on the US. But, the US, I think, is generally pretty protective of our tax policy, and Congress, they're the ones that set tax policy. And so I think for them especially, they see themselves as the first movers, under TCJ in this space. And Section 899 was sort of the culmination of all of that, again, Congress sets policy, and this was sort of a step, to address what was viewed as trying to overtake U.S. tax sovereignty, or to step into a place where the U.S. really should be controlling what their tax laws were. And so ultimately, I think 899 happened because Congress, wasn't going to let its tax decisions be decided by, another body. Beyond that, a lot of the lessons learned, I think, have to do with just sort of how we interact, on issues like this with Congress. When you have a big retaliatory measure, how you go about trying to get something like that removed, and it frankly was just a significant uphill battle. I think for the first time in my time in Congress and off the Hill, I was confronted with a provision that was there were no champions on trying to get it removed, right? It was something that the administration wanted, congressional Republicans wanted, Many of them recognized that the policy was going to be bad and have significantly serious ramifications, but they were going to move forward with it instead. And so they really used that as a stick. And it was very difficult to sort of try and combat that with, you know, highlighting what the negative impacts of that policy were going to be. And so what it really took was, I think, expanding the universe of, who is impacted by these negative tax policy changes that could be made. It's not just, in our instance, it wasn't just the foreign parented companies that were going to be affected. It was the broader U.S. economy, and making sure everyone sort of understood that the world of horribles was larger than what everyone initially thought it was going to be was really important. I think more broadly, lessons learned in going forward is that it's a lever. Retaliation is a lever. Retaliation in tax policy is a lever. And just because, Section 899 went away in this instance, it doesn't mean that something like this might not pop up again down the line, whether it's if the side-by-side deal implementation doesn't work out how Republicans in Congress hope it does, will something like this come back? Is it another response to DSTs? Is there some new retaliatory provision down the line? Your guess is as good as mine.
Thank you, Jennifer. Thanks for that. I mean, I noted back in when January 20th, when the president released his flood of kind of executive orders and he put out his America First trade policy, a couple of tax provisions were in there in terms of things that he wanted to look at and potentially use and for to have in his arsenal. So 899, I think, is as you've illustrated, is really a strong part of that. And I look forward to maybe picking bits back up a little bit because I think there's also whereas tariffs were also considered something that was congressional responsibility. They've really pushed the boundaries on that with the executive level, and it feels like tax has somehow avoided that a little bit, but maybe I'm misreading it. Lauren, following months of intense negotiations, the package on Pillar Two side-by-side arrangement of the OECD agreement was announced on January 5th. Can you briefly walk us through a little bit the history of this agreement, where we stand, what happened, and what are the biggest challenges that are left? Maybe talk a little bit too about how China showed up kind of late in the process. I thought that was a very interesting twist in that saga, and would love to kind of hear your perspective on that. Um, and how do you see the next steps in Pillar Two adoption, not just in the United States, but globally, and then, potential ramifications? Is this something we have to have an eye on for 2026?
Sure. Again, thanks for having me, and look forward to the discussion with my co-panelists. The history of where we are today, I can give you kind of the long or the short version. Some of you who have been following the Pillar Two discussion since the beginning might feel like we have just done like a full 180 because we're kind of back to what the Treasury Department was advocating for kind of at the outset after GILTI had been enacted at the end of 17, arguing or advocating for their position that GILTI was a sufficient minimum tax in line with kind of the larger, broader policy goals of Pillar Two, and so we should have what was then called GILTI coexistence. And then we went from that to some technical rules in the guidance whereby you had push down of GILTI taxes, so recognition that some of the taxes paid under the GILTI regime should count at the CFC level. And then finally, the side-by-side safe harbor that we saw released 2 weeks ago, 3 weeks ago. It's important to highlight a couple of things. One, what we are calling the side-by-side agreement really has four components, and it's not just relief for U.S. headquartered multinationals. If you look at the administrative guidance that was released January 5th, you will see that of the roughly 85 pages, I would say probably 70 of them are taken up, or 65 of them are taken up with a discussion of the ETR simplification safe harbor, which applies to all multinationals who might be within scope of Pillar Two. And that would serve to exempt them from all top-up taxes. So IIR, UTPR, as well as QDMTTs. And so if there's a minimum rate of 15% or more, then you're out of the Pillar Two regime altogether. So that I think is a significant effort that the Inclusive Framework and the OECD is undertaking in terms of the work behind what remains to simplify the ETR calculations, both for taxes and for income. And they will continue to make significant advances in that area for the work of 2026. That is high on their priority list. Also, part of the rules is a substance-based tax incentive safe harbor, which again applies to anyone who might be within the scope of Pillar Two. That, of course, includes relief that many, both U.S. headquartered multinationals as well as subs of foreign parented multinationals operating in the U.S. who might take advantage of our highly revered, highly coveted R&D credit, which, as many of you who are not even in the tax space will probably know, is not refundable and led to certain negative outcomes under the Pillar Two rules. Those rules have been modified to take into account both production-based and expenditure-based credits and offer some relief there. There are some caps that apply, but it's a big big advancement for all jurisdictions that might offer tax credits that don't take the form of refundable credits. And then, of course, we have the side-by-side safe harbor, which exempts, at this time, U.S. headquartered multinationals because of the rules around what is a qualified safe side-by-side regime. What does that look like? As of today, the U.S. is the only jurisdiction that meets those requirements. There um, of course, are ways that others might be able to submit their regimes for consideration. So they're not U.S. specific, but they're described in ways that would certainly clearly cover the U.S. regime. So both the domestic tax regime as well as a worldwide tax regime, which broadly encompasses our 21% rate, the CAMT subpart F for foreign passive earnings, GILTI for foreign active earnings, and a recognition that we being U.S. headquartered multinationals would still be subject to QDMTTs around the world, and that those QDMTTs would be creditable in the U.S. And then the last component is the UPE safe harbor, which is kind of like half of the side-by-side safe harbor for those jurisdictions that have a qualified domestic regime. So a corporate income tax rate of at least 20%, and a domestic kind of minimum tax akin to a QDMTT, or similar to the CAMT architecture, would have all of their constituent entities that are located in that UPE jurisdiction be exempt from imposition of the UTPR. So, a broad set of rules. I'm going through them at a very, very high level, but certainly relief for U.S. multinationals, as was promised in the G7 statement from last summer, which really was, as Jennifer alluded to, kind of a deal to get part of a deal to get 899 out of what became one big beautiful bill. But also in that statement were promises to simplify the regime altogether, as well as offer relief for some different types of tax credits.
Lauren, can you just help me? So I'm not a tax expert. I pretend
What?
I pretend I'm one for the occasional virtual event. Can you help me? So, I mean, for Pillar Two, I'm going to oversimplify, but basically, if a corporation is paying less than 15% tax,
Mm.
then the foreign jurisdiction can top up the tax that they would apply to that corporate. Is the U.S. really at risk, or U.S. corporations really at risk of falling below that 15%? Is this a paper tiger or is this a real situation? And I only ask because the two corporates I used to work for had effective tax rates of around 22, 23%.
Mhm.
And GE had the most effective tax planning tax regime, and even they, I think, were at like 19 or 20% at times. So I'm just help us think through when will this actually impact, or how would this be triggered?
Well, prior to the side-by-side agreement, I think it was a real danger, particularly because of a couple of things. One, significant aspect of our domestic tax system is the R&D credit, and it is non-refundable. And so, under the Pillar Two administrative guidance that existed prior to the issuance of the substance-based tax incentive safe harbor, the treatment of non-refundable and refundable credits was very different. And a non-refundable credit. Was not treated as an accretion to income because you weren't getting any cash back. And so when you calculate your effective tax rate as a US multinational who takes significant, advantage of the R&D credit, for example, to a significant degree, that could operate under your ETR might be above 15%, in the US as calculated. But we have to remember that Pillar Two looks at book, not tax.
Okay.
And the operation of how those credits impacted your ETR calculation under a book tax calculation or book calculation was very different. And so that
And
was
ETR is effective tax rate, right?
effective tax,
Okay,
effective tax
perfect.
rate. So not a tax, I'm getting into accounting and I am not an accountant, so that's dangerous. But I'm getting into how you calculate tax for, your tax return purposes versus how you might think of it from a financial statement
Got it.
approach. So yeah,
Got
it
it.
was real. It was real.
It was a real, okay. So it was a real concern, not just a paper tiger that,
Not just a paper tiger. And so then you start to have the scenario in which, we were discussing earlier, whereby US multinationals were being assessed taxes not based on necessarily even what is happening in the US, how much tax they're paying here and whether or not that's a sufficient rate, or even, somewhere else necessarily. It's just to top you up.
got it. Okay. So thanks for that. Very, very
Sure.
helpful explanation. So, um, um, uh, Sean, just let me turn back to the DSTs, and kind of where we are. So, this has been a priority, I think, for the U.S. We have a surplus in services, a surplus in particularly digital services that we sell around the world. At the same time, this administration has been very focused on applying tariffs to goods. And so you can't really apply tariffs to services. So if foreign companies want to retaliate or level the playing field for their companies with regards to services, they either have to look at domestic regulation or taxes because of the lack of tariffs availability for services. So the U.S. has negotiated lots of trade agreements in 2025, still trying to conclude some. And in some of those, they have tackled the issue of DSTs, particularly with regards to Southeast Asia. But it's not in the US EU framework, and I don't think it's even in the US UK framework. And so help us think about where this issue might go in 2026. What may happen with DSTs and coordination and Jennifer and Lauren, I'll probably bring, ask you for your comments on this as well. But I think DSTs remain quite a big issue out there, particularly with regards to the president continuing to kind of throw tariffs around willy-nilly and digital services taxes seem to be something that other countries kind of have in their arsenal to go after our surpluses.
Yeah, so there's a couple ways of thinking about this. So in one respect, DSTs are based on your revenue effectively instead of your profit. And so what that essentially means in economic terms is they do actually kind of serve as a tariff on services. The economic incidence is very similar, meaning that, for example, a French DST that is placed on, let's just say, a US or a Chinese tech company that's operating in France, um, the actual incidence of the tax, who's actually bearing the economic burden of that tax is the French consumer of those goods, those services. Politically, yes, you can say we are going to put this DST on name your US tech company or your Chinese tech company, and they might legally remit. They might actually send the check to the French government, but the actual people who are paying that burden are the French users of those services. which might sound like a very familiar story to those in the US who are following tariff policy. If we are tariffing a foreign nation on goods that we are buying, it's the US consumer and the US importer who are actually bearing the costs of those tariffs. So economically speaking, DSTs they act very similar to a tariff on services. And I think this is where, to your point, the U.S. exports a lot of services to Europe. We import a lot of goods from Europe, and so there's this big imbalance in our trading relationship where Europeans are consuming a lot of U.S. service, Americans are consuming a lot of European goods. Of course, there's both on both sides, but that's the predominant. And so you could take a view of DSTs as saying, well, Europe decided, well, France was the first one back in 2018-19 who decided to levy a DST or a tariff on services. And now that's their leverage, right? Because they have a lot of US services in Europe. Well, our leverage would be as a response, tariffs on European goods, because that's what they export here the most. So there is a view of the world where, yes, our tariff policy in the United States, broadly speaking, has been not necessarily the most linear, let's say. But there is a deeper understanding of some tariff policy, specifically in regards to the European Union, which is even in Trump 1, we were using specific types of tariff, 301 tariffs that use congressional investigations, that were well thought out, well planned. They were bipartisan. This goes back to 2016, 2017. This is not one of those cases. The DST issue in Europe is not one of those cases of somebody wakes up and puts something on the internet and now that's our trade policy. This has been a long-standing issue with a lot of bipartisan support. So that's kind of one view of the world and why the US might be responding. So, why the DST issue is still an issue. On the other side, the question is, well, why, for example, are we coming to trade agreements with Malaysia and we are explicitly writing no DSTs, while in the UK and the EU that language is not there? I have two explanations. I don't know if either of them are correct, but we can talk about it. One would be that the US is still hoping for some international agreement, and they see, the EU, the UK, the US working through a Pillar 1 solution at the OECD, or if we all agree that Pillar 1 was not going to happen, some other version of an international agreement on kind of the reallocation of international taxing rights, because DSTs are kind of a proxy for that larger issue of international allocation of taxing rights. So if the United States thinks that there's a better deal to be had on the reallocation of taxing rights internationally, and we want to work with our partners and our allies, I think they still are, on kind of international agreement, that would be the best way. So you would want to leave that out of a trade deal because you would want to work on that at the OECD or the UN or some other venue. The other hypothesis is that it's actually about power, and Malaysia is not in a particular, and I'm using just Malaysia as an example, but any of these countries who signed an trade agreement with the US that kind of explicitly says no DSTs. For a lot of those countries, DSTs are not necessarily that important for them, their economy, or in particular, their domestic politics. In France, DSTs are very important for their domestic politics. French politicians have been talking about DSTs and why they're going to stand up to US tech for a long time now. I don't think that's necessarily the case in some of these other countries. So it's not necessarily difficult for some of these countries that don't have a lot of DST revenue anyway. They were never really going to do a DST to begin with, and nobody in their country is asking for one particularly. That's not necessarily a hard sell, right? And in the UK and in Europe, that's different. So you could argue the US is holding out for an international agreement. They want to work with their allies, which I think is true to some extent. There's another version of this where the US is taking countries off the large map of places where they would face a DST. And so if they're going to have to retaliate, they will be focused on the ones that are still using them, like in Europe or the UK. And that would be 301 tariffs or some other retaliation. So I'm hopeful that there's an international solution, but I think it's probably more complicated than that.
I mean, the other thing that for me, I mean, obviously they're a great retaliation tool, but we are seeing more and more of our economy move from kind of the physical to the digital. And digital services are growing 9, 10%. And with being on the cusp of all of these AI developments, I mean, this Anthropic CEO piece from yesterday I read last night is talking about how in 1 to 2 years, 50% of white collar jobs could be wiped out in the United States. And that's a whole lot of tax revenue that's suddenly shifting somewhere else. So, I mean, it seems to me that there also may be some other reasons why you would want to have digital services taxes as you look at the future of taxation generally. But let me turn to Lauren. You came off mute, so I didn't know if you wanted to have a answer on that.
I do. I mean, I think Sean is right. We're gonna have. I think of DSTs in the larger bucket of kind of extraterritorial taxes, and you might recall things like Germany's Section 49 issue that was hot a few years ago, kind of being swept up in the conversation and formulation of early ideas of what ultimately became Section 899 in this year's or last year's draft legislation, and so the point about what are we going to do as to how we define jurisdictional nexus is a much larger question, and I think that it's something that we're going to have to think about. Our current treaty network is not equipped to deal with the way that the world is moving, and it may be that AI pushes us to think differently and come to some real um, conclusions as to how we're going to re-articulate these principles and make sure that they're fit for purpose in the 21st century. I do believe that, um, whether that happens within the context of Pillar One or outside the context of Pillar One, remains to be seen. It's almost, it's kind of like, well, we just want it to happen. One might imagine that it is somewhat dependent upon the appetite of whatever administration is in power for dealing with these issues through some kind of multilateral organization or using our own relationships. And Sean, I think you put it in good perspective. And we're probably doing a little bit of both, where we can extract some concessions on DSTs from countries that may not really care about DSTs. Why not? And then for those who do, let's think about other ways to address what has become the shorthand DSTs for a lot of these taxes that countries are imposing. And I do believe that it's somewhat cabin to the European Union, and maybe the UK, maybe Australia to some extent. But the ideas around, sometimes it's just a different way of taxing old regimes that U.S. multinationals might have had in place, old structures, but then um, kind of using ATAD as a defense for kind of novel ways of imposing taxes on operations in a country that might really relate to operations in another country. So, let's think about these creatively. That's the new frontier, I think, in tax policy. But I do think AI is going to push us. How we're going to tax it and how we're thinking about it might be the catalyst for these conversations.
Yeah, Jennifer.
Yeah, I just wanted to pull on one lever that Sean mentioned earlier, and that's, looking, for example, at France's DST, and I think he called it very political. And I think that is right, and that's something that you see a lot with the European Union in particular, right? They can't, again, these are sort of political agreements that we're talking about, but DSTs are dealt with over there sort of at the jurisdictional level. So, France, for example, that DST is, very much something that they pursued as a way to sort of go after US tech to have it has a political meaning behind it. It's not even that they're bringing in a significant amount of revenue. I mean, I heard that during sort of the 899 fight, because if you remember, in at least some iterations of Section 899, there were certain taxes that were called out as discriminatory. UTPR obviously was one, but DSTs was another that was specifically called out as being a discriminatory tax. And so, I think that they're, particularly in Europe, very political in nature. I was told multiple times by, depending again on the jurisdiction that has the DST, that they're not uh, necessarily economically significant for certain jurisdictions, but they're politically important in how those countries sort of see their posture with the US and US tech companies. And so I think that's an important thing to be thinking about, as well as just sort of what happens, if these taxes continue to proliferate. Obviously, we saw Section 899 earlier. I think that mechanism was more geared at sort of the broader Pillar Two question. The administration, obviously, in the past has, as Sean and I think Lauren mentioned, dealt with DSTs more through a trade lens, 301 investigations, for example. Um, but if they proliferate, or if, different jurisdictions try to change the terms of what their DST looks like, or, do they expand what services are covered? Do they expand the thresholds as the tax itself get larger? What sorts of way might the US retaliate? Or, alternatively, are we looking at a scenario where we're reopening, maybe not actually reopening Pillar One, but reopening that conversation maybe in a different forum?
Yeah, I mean, I think the services issues remain, whether it be taxation or tariffs, remain a very interesting and intriguing issue, and very different and distinct in many ways from goods. So, I mean, we haven't seen it yet, but the president wanted to do a 301 on film subsidies. Um, that seems to have gone kind of quiet, maybe in part because figuring out how you would levy any kind of remedy if you found unfair subsidies on that film production for digitally conveyed goods is challenging and runs counter to US policy that they're advancing in advance of the WTO meetings this spring to put a moratorium on such tariffs through the e-commerce moratorium. So I think,
To just jump in, Penny, if I could for a
yeah,
second, to pick up on what was said. So I think an analogy that is not perfect, but might help those who are not in the tax world understand some of these kind of parallels. The administration's tariff policy is based on the assumption that the world's trading system is broken, specifically the enforcement mechanisms don't work the way that they're supposed to, and therefore we need to have a US tariff policy that goes around and kind of redraws the rules of international trade and enforcement, and these bilateral agreements. Here are the terms we just saw with South Korea literally yesterday or today. Here's what we agreed to. You didn't do it. Here's the enforcement. We're going to basically push you to do this with, using the mechanisms. Okay. Whether that's right or wrong, I think that's the kind of underlying assumption of our tax policy is the international trade system's broken. We need better enforcement. The US is going to use its power to enforce. Okay. The same thing is kind of happening on the digital services side from Europe. Europe is saying the reallocation of taxing rights based on nexus is broken. It used to be 50 years ago that wherever the plant was, wherever the cars were made, you had the first taxing right, and whoever you sold those cars to, they got a second taxing right. These days, users in France or in Germany or in any other country, for example, are where the value is created. So it's not necessarily about where the US tech headquarter is or where they produce, the tech. It's about the users who are creating the value. And therefore, it's not we need to change the way the international tax works. It's not just where the plant is, it's where the users are, and that's the fight. And so the way that we've used tariff policy to try to redesign the enforcement mechanisms of global trade is how the DSTs are trying to unilaterally change the rules of digital service taxation and international taxation of services. The posture of the European Union and many of these countries, I should say, they have said many times, we have a political problem in our country. People don't think it's fair. We need to do something about it. We prefer to have an international solution, but until there's an international solution, we are going to have our national DST. And so they've used this as a power structure to say, we're going to have this kind of enforcement plan B if the international agreements don't come to fruition. I mean, where have you heard that? That's what the US is doing on trade, right? They are saying, we want this. If you don't, here are the consequences. And so that's what's been happening in Europe specifically, and in other countries that have DSTs against kind of the US tech sector. So the question is, and this is kind of going to Mark Carney's speech, well, Does Europe see itself as a middle power, as the way Mark Carney described them as? I don't know. Actually, I think they would disagree to some extent. But the second question more broadly is, well, can you use power that way if you are a middle power? And is that what you should even be doing? And you could argue yes or no, and you could say yes or no. But for me, the question is, does it work, and what are the costs of doing it? And that's kind of my bigger question to all of this.
But Sean, that sounds like, sorry, Penny, that sounds like trying to use, if we agree that DSTs are really a trade measure, it sounds like, everyone's trying to use trade measures to effectuate a tax outcome. If we,
Mhm.
and I'm not,
Yeah.
as a tax purist, I'm like, well, I don't know that that is the most effective way to go about this.
Yeah.
I don't think it's a good strategy. I'm just saying that is the strategy.
That is what's happening. I know.
Yeah.
Well, I mean, we've seen tariffs used for four different reasons, at least the past year, right? Reshoring, rebalancing, leverage for all kind of unrelated geopolitical issues, and then for their revenue. So, I mean, you also have, for us trade purists, you have pure trade instruments now being used for that have real trade impacts, real economic impacts, but are being used for completely unrelated reasons. And so it's a fascinating time that we're in. I haven't seen any questions come in yet, but I just wanted to say to the audience, if any of you have questions, to please pop them in the Q&A function, and I'll be happy to incorporate them. Um, One question that I actually didn't prepare for all of you on, but I was just curious, was we also have this huge push going on around critical minerals and around extractive industries. And I'm just curious if there's any tax implications that we need to be keeping in mind. The USTR is going to go off and try to negotiate a whole bunch of trade agreements on critical minerals, trying to secure our supply in all of these rare earth elements, as well as other metals that we need for a variety of processes. And is there anything in that space we need to be keeping an eye on in terms of tax implications and how they're going to play out in the critical mineral space? I'm sorry, this is a wild card issue for a wild card I'm throwing out.
I mean, I would let Lauren sort of speak to the practical tax practitioner implications, and this isn't specific to critical minerals, but before we joined the panel, you and I were sort of talking about the role of tax policy and innovation. And I believe, you mentioned the R&D credit, which again, Lauren touched on is beloved by many here and there. And that is, one sort of driver in innovation, but at the same time, the uncertainty with tariff policy and other, I think, political elements, tamp down on how much benefit one can see from some of these tax policies meant to drive innovation. But it's still seen as sort of the gold standard here is looking at R&D as a driver of innovation. And I think something that we've been seeing and have seen for a long time in the US is that, the tax code isn't just about funding the government or social programs, paying for the military. It's also used to drive public policy. The R&D credit is one way that happens. But I think public policy and promoting innovation are inextricably linked. And so something that maybe we could see is, and that we've seen in the past or members of Congress proposing additional tax credits or tax benefits to sort of incentivize certain types of technology, innovation, R&D. And so maybe you'll see something like that in the world of like semiconductors or critical minerals. What that exactly looks like, I'm not sure at this point.
Yeah, I would agree with Jennifer. I don't, under the current system, I don't see any particular issues. I do think that we have seen, she mentioned the chips credit, energy credits popularity has waxed and waned across administrations over many, many years. But thinking broadly about like production tax credits, those have been in the code for a very long time. And if we think about trying to incentivize certain behaviors or certain industries, that's certainly a way to do it. A tax credit is a way to do it. Grants are another way to do it. Non-tax incentives. So, we'll see what happens with that, but it's always a tool.
Thank you for that. We have had a question come in from the audience. I'll ask it for Artem. He's asking for your prediction for the future of the digital services tax in the EU and the UK, as well as Pillar 2 globally. Sean, should I kick that one to you?
Sure. So so here's how I think about DSTs. DSTs can really go, I think, in two ways. They can either go in the cooperation bucket where we all find an international solution to the reallocation of taxing rights, and that would probably stop the proliferation, maybe, of DSTs. But the problem is, and this has been the problem the whole time in these international negotiations, is what is a DST actually? And if you solve an international agreement for some version of a DST, uh, how do you enforce if a country decides to do something that's not really a DST under the international agreement, but it's kind of basically the same thing, just applied to a different base? So the second outcome is essentially they proliferate in different ways, and the question is what do the countries' tax bases who would be losing from that or whose companies would be targeted, what do they do in response? I've argued for a long time it doesn't solve the political problem, as Jennifer was mentioning, and I've said before, like if you think of DSTs as just a pure revenue raiser and your goal is effectively to tax the digital economy in a more efficient way, Europe is way ahead and the UK is way ahead because they have a VAT system. And that is really a great system to tax, more efficient, I should say, to tax these things. But that's not what DSTs are about. Like, they are not necessarily about being the most efficient to raise revenue. They are about a political problem that they're trying to solve domestically and trying to change behavior internationally. So, my kind of bold prediction here is that they're not going to go away because in a lot of these countries that have them already, the politicians have made compelling arguments for why they need them and they've had them in place and now they're earning revenue. So you'd have to replace the revenue if you wanted to get rid of it in the domestic budget. And so the question for the US and China, I guess, those are the two most affected countries, is what is the price to pay for having one, unfortunately. And that's kind of the issue for these countries is they've outsourced the price. The price is whatever the retaliation is. So they control the policy and the retaliation comes from the outside. Again, my stated preference for the record is that there's an international solution that doesn't kill FDI and everybody works together. But I don't know if that's the outcome. Pillar two is more interesting, actually, in my view, in the sense that it's going to be a big problem in Europe from a legal perspective. There are a lot of European lawyers who are pretty upset at Article 32 and the way that the side-by-side agreement was implemented in the EU. And so you might see some legal challenges at the member state level from countries that are having to implement the side-by-side agreement in a way that is pretty inconsistent with EU law. So that's well beyond my remit as an economist, European law, but I think that's actually a pretty interesting area for Pillar 2 this year.
And Sean, just briefly, I mean, France and Canada and the UK get a lot of reference when it comes to DSTs, but my understanding is that the highest DST rate in Europe is actually in Hungary, and that they have a 27% plus a 7.5% charge that they collect on their DSTs, and it's a significant source of revenue for them. And I just noticed that Hungary doesn't get mentioned very often when it comes to DSTs, but we hear a lot about France and how bad they are. So I was just
Yeah,
um,
maybe Jennifer or Lauren know more about the specific Hungarian policy. I mean, I think from my understanding, they have I think it's a tiered VAT system, if I'm correct, but Lauren or Jennifer, if you have more insights.
I don't have more insight on the Hungarian DST specifically, but I will say it's not just about that level of tax, but also sort of the threshold of who the DST, what size of company the DST might apply to. Right now, I think it's generally accepted that they apply to, large multinational companies, predominantly US companies, but you know, implementing things like this, it's a slippery slope. You start to bring in some revenue and then you think, hey, I need more revenue. Those thresholds could get they could start applying to companies that are smaller and smaller in scope. And so, you mentioned in my previous job, I worked in sort of the tech space, and there was the concern that smaller tech companies would eventually, or smaller companies broadly, but in my case, it was tech companies would get lumped in. And so I would also look at those jurisdictions that have DSTs that might target smaller companies. It may not be, whatever the Hungarian threshold is, but yeah.
Thank you, Jennifer. One last question has come in, and maybe Lauren, this is for you. The carve out for non-refundable tax credits was largely intended to prevent low tax jurisdictions from increasing their statutory tax rate to 15% while offsetting the increase by granting non-refundable tax credits to companies, thereby leaving their effective tax burden unchanged. Under the new side-by-side system, do you think there is still sufficient protection against this kind of behavior to ensure that the corporate income taxes truly have a minimum floor?
Yeah, I don't know that that was the impetus necessarily. I do think that what the OECD will say about the new substance-based tax incentive carve-out is that they want to, one, avoid a cliff effect that, for any dollar over the threshold that you had of non-refundable tax credit, you would be fully in the Pillar Two system, so liable for that delta, the full amount of top-up tax, and also to inject some parity in terms of how credits are treated, not on the basis of refundable or non-refundable, but on the basis of the substance of the incentive. So, as I mentioned earlier, whether they were expenditure-based or whether they were production-based, as the policy behind what kind of credits would be recognized and given a special treatment, if you will.
I would also, Lauren, add on that, what you said. There are a number of developing countries that have non-refundable tax credits that, that's the only kind they really can have. And so I think, when you mention that element of parity, I think that factors in as well.
Yeah, good point. I agree.
Thank you both for that. We're in the final 5 minutes. We've got a couple of quick questions that have come in. Let me read these both off quickly and see if you guys want to answer them as part also of any final comments you want to make. So first question for Sean and Jennifer. In the US, about 30 of the 50 states have implemented a tax or fee on digital services, often by extending or adopting existing sales tax frameworks. How do you see the future development of digital sales taxation in the United States? And then second is there any push to restart Pillar One discussions in light of all of these discussions around DSTs? So let me give you guys a lightning round, kind of a 1 minute final comment or answer either of those two questions. We've spent a lot of time on DSTs as well as Pillar Two on this. So I think those are hot topics for us for 2026. But let me start in kind of reverse. So Lauren, let me start with you for any kind of final thoughts and or answers to either of these two questions.
I'll pick pillar one since we've kind of given that short shrift in this conversation. I would imagine that the view from the inclusive framework is that those conversations need to continue. I'm not certain that there's a whole lot of will to continue pillar one as it is today. I mean, obviously for amount B, the US has taken somewhat of a revolutionary step and issued a notice. The service has issued a notice saying, we're going to accept these principles more or less, and taxpayers can apply them. They don't deviate largely from 482 principles that are already in place. So it's surprising that they're taking kind of a multilateral concept and implementing it domestically, but not surprising in that the rules are consistent. On the amount A question, which is really what would combat digital services taxes and things of that nature, I think it's harder. It's a very complicated framework that they articulated, at least preliminarily. I don't know that it has to be that complicated. But what we really need to get at is what Sean and I have been saying over and over in this webinar, which is we need to rethink the way that we assign or allocate jurisdictional nexus to tax. How are we going to do that for the economy that we have today? And that kind of agreement could come, on a smaller scale than the inclusive framework writ large, and be something that perhaps the U.S. spearheads with its primary trading partners, and then gets kind of spread out to others. So we'll see. We'll see where it goes.
And so, final 10 seconds, Lauren, what's your any predictions for what are going to be the top priorities in 2026?
Oh, from a tax perspective, I think domestically it has some things that are not, the subject of this webinar.
Yeah,
There are health issues, health tax issues. There are crypto initiatives, crypto tax. We'll see where else we go. Retirement, some things that have nothing to do with what we've been discussing domestically, and then internationally. I think we're looking at Pillar Two implementation and how that rolls out.
great. So, in short, you'll be busy, but if anybody needs help, you're available.
Yes, yes.
Okay. Jennifer.
On the sort of state issue, I might leave most of that to Sean. I've sort of left much of my state work behind. But I do think the states are sort of a barometer for, the trend of where things are going. States have sort of used digital taxes to shore up or try to shore up some of their budgetary issues. And so Maryland was the first mover there, and I don't know, they could still be embroiled in their lawsuit. I'm not actually sure. I do think there's appetite to sort of reopen the Pillar One question. Maybe not reopen. Many people I talk to say Pillar One is dead. I'm under. That being said, I think in some sort of international conversation, when I was knee deep in 899, multiple parties, be it foreign partners, folks in Congress, I had heard, on more than one occasion that they hope to turn to that issue again after we've sort of shored up whatever is happening with 899. And I guess sort of to answer your question of, what is happening next year, and I would maybe counter that with not, not so much of what I think is going to happen next year, but the broader topic for this intersection of trade and tariffs and tax conversation is there's been so much uncertainty, whether that's through, the Pillar Two discussion and the sort of overarching 899, at least in GBA's world, was just such a huge sort of inflection point mixed with what is a day by day tariff situation. I think it does take a lot of oxygen out of the room for things that we could also be doing instead. For GBA's purposes, that is a beat high tax exception, for example, is something we've worked on for a long time, and there are folks on the Hill and elsewhere that care about that, and we'd love to sort of give some oxygen to that. Thinking about sort of OB3 implementation, there's still regs out there that are needed that we haven't seen yet. There's also still a lot of things in the deregulatory agenda. And so those are a few things in the tax space that are out there that, we could be directing some energy to.
Thank you for that. Sean, final 30 seconds. You get the last word.
Yeah, so I think from the European perspective, I'll just say I think Pillar Two implementation and kind of the legal questions is step one. Uh, DSTs slash tariffs with the United States and how they respond, not only economically, but from a legitimacy and credibility perspective, from a European perspective, standing up, quote unquote, to the US in those ways is, I think, going to be a big story in 2026. We've already seen it. And then finally, I think just what does Europe actually need to do to be competitive? And is Europe going to make the decision to stop focusing on changing tax policies in other countries and start focusing on what's best for Europe and what makes Europe most competitive and how they can, build a single market without interior barriers that would make the European economy much stronger and focus on growth? Because as we've kind of known for a long time, but I think we're really seeing economic growth is a tool in geoeconomics. And so it's not just a nice to have, but it's actually something you need to try to achieve. So I think those are the top three things.
Well, thank you. Thank you to my partners at Tax Foundation and to Sean for helping to organize today's conversation. I am not a tax nerd, but I always enjoy these conversations. I learn a ton. I think tax is so important to business strategies, which then underpin our investment and our competitiveness strategies. So it's always a fascinating conversation to have. So thank you all. Thank everybody for listening. And in particular, I want to thank our speakers for joining today. Lauren, Jennifer, Sean, thanks so much for it. This was recorded and it will be available on YouTube. And you can also, I think, follow any of us on social media, the GBA, the Global Business Alliance, the Tax Foundation, the German Marshall Fund of the United States, and I'm sure Skadden, for any follow-up or to reach out to any of us if you have additional questions. Thanks again, and enjoy your day.
Thank you.
Thank you.
Thank you.